Okay, so let's unpack this. Welcome to today's deep dive.
Glad to be diving in.
It is Monday, February 23, 2026, and if you have Lululemon in your portfolio, you are probably looking at a close around $177.92 today.
Yeah, a really painful 5% drop.
Exactly. But looking at the technicals, this doesn't feel like just a standard market fluctuation. It feels like the market is fundamentally rethinking what this entire company is worth.
It absolutely is a repricing. I mean, Lululemon has historically traded like a high-growth tech stock, but today it is trading like a distressed asset.
Which is wild for such a giant in the retail space.
Right, but we're seeing a perfect storm scenario here. You have a legal blow from the Supreme Court, a massive product quality crisis alienating their core base, and a boardroom power vacuum. All of it is hitting at the exact same time.
Let's strip down the headlines first, because they are all pinned on the Supreme Court delay. It involves the International Emergency Economic Powers Act, or IEEPA.
Yeah, which sounds incredibly boring on the surface.
Right. So why did a procedural delay there trigger such a massive sell-off?
Because it was a classic sell the news event, the market had already priced in a win. Specifically, investors were betting on a massive refund check for duties Lululemon had paid in the past.
Oh, I see. So when the court delayed the ruling.
That immediate cash injection just vanished from the forecast. But honestly, the bigger threat to their P&L isn't the missing refund. It is the removal of the de minimis exemption.
Right, the de minimis exemption. That is the trade rule allowing packages under $800 to enter the U.S. duty-free.
Exactly. It has been this massive loophole for direct-to-consumer shipping.
And with that closing, analysts are projecting a $240 million hit to Lululemon in 2026 alone.
Yeah, $240 million. That wipes out a huge chunk of their operating leverage. But here's where it gets really interesting. That tariff hit is just a math problem.
Meaning they can fix it.
Right. It is solvable with supply chain tweaks, but the quality control issues, those are existential.
Okay, let's get into the juicy part. This brings us to the Get Low and Heart Scatter collections. Social media right now is flooding with reports of these leggings being sheer.
Completely see-through when you squat.
Right. And for a brand that literally built its entire reputation on the squat test, this feels like a major violation of the brand promise. It is not just a manufacturing glitch.
It's a violation of trust. And the corporate response actually amplified the damage.
They didn't do a recall, did they?
No. Instead of a recall, they suggested customers just size up or wear skin tone underwear.
You are kidding.
It is incredibly reminiscent of the 2013 Lululemon recall, but the context is so much darker now. Analyst Neil Saunders actually coined a term for this. He calls it junkification.
Junkification. That is a brutal term. It implies they're basically resting on their laurels instead of focusing on lab results and fabric tech.
It means they are pivoting from technical innovation to just being a logo-centric brand. They are banking on you paying a premium price just for the logo on the back of the leg.
Rather than the actual fabric performance.
Right. And when you stop innovating on the product, you open the door for competitors to just walk in and steal your technical status.
And looking at the landscape today, that door is wide open. I mean, you have Alo Yoga capturing the exclusivity and lifestyle market. Their store visits are up 38%.
Which is huge.
And then on the performance side, you have Nike's Project Amplify. And On Holding, effectively winning the tech war, Lululemon is getting completely squeezed from both sides.
They are stuck right in the middle.
Yeah.
And usually when a company faces this kind of identity crisis, you look to the CEO for a vision.
But Calvin McDonald left in January 2026. So we have a ship with no captain taking on water. And I hear the crew is mutinying.
Oh, it is total chaos. Chip Wilson, the founder, is back launching a proxy battle.
Wow.
Yeah, he wants to declassify the board. He's calling the current oversight a total operational failure. And on the other side of the ring, you have Elliott Management pushing for their own board picks to drive efficiency.
So it is essentially a war between the founder who wants to restore the brand's soul and hedge funds who just want to optimize the margins. So what does this all mean for you listening right now? The stock is currently trading at a humble 13 to 14 times earnings. Historically, Lululemon commanded a 30 to 40 times multiple. So on paper, it looks incredibly cheap.
It is cheap, but you have to ask yourself, is it a discount opportunity or is it a value trap?
A value trap meaning the stock looks cheap because the price fell, but the actual business fundamentals have permanently deteriorated.
Right. That is the gamble here. If the junkification is real, that premium multiple is not coming back. If they are just another apparel company selling expensive polyester with a logo, 14 times earnings might actually be fair value.
It really leaves you with a provocative question to explore on your own. If a premium brand loses its core quality and its leader, is it just an expensive logo? Can they somehow regain their soul before their muse leaves for good? Thanks for diving in with us.